Hi, I'm Emily Thornton with Business Week, and I'm here with Kohlberg, Kravis, and Roberts co-founder Henry Kravis. We're here to talk about private equity. Thanks for doing this.
Happy to be here with you.
So you've seen so many different private equity cycles. How would you describe this one?
This time, everything slowed down at once, number one. Number two, what's different this time is credit really just shut off. It reminds me a little bit of 1979 when Paul Volcker, who was then head of the Federal Reserve, put on credit controls. And we had just announced that we were going to take a company called Foremost McKesson private, from public to private. And it was announced. We had a signed agreement subject to financing, and he came out and said no more non-purpose lending, which meant acquisition funding was gone. And so this reminds me of that. Totally different. There was inflation at that time, different reasons for it, and he was trying to break the back of inflation. This one is because the bubble burst, and as a result, literally all credit, in this case, just literally stopped. So it wasn't a question of could you buy anything if you could get financing. You could not get financing this time. It really shut down.
So going forward, is the main challenge still getting capital in your view, or?
Yes and no. The market is opening up. We've had a number of banks come to us on some specific financing where there's a company we'd like to buy, and they said, yes, we can help you. We're prepared to do it. It's just different this time. So what will happen this time is the financing will be much less leveraged. Much more equity will go into a particular capital structure. You may have today a structure where you have one part equity and one part debt, and then that may translate into 4 to 5 times debt, total debt to EBITDA, whereas before you might be up in the 7 or 8 times, again depending upon the industry, debt to EBITDA.
Right.
So that part has also changed this time. Now, but that's happened in the past. I mean, when we went through a slowdown in the early 90s, that happened at that time, and you went down into a less leveraged situation. It went the same thing in early 2002, let's say, where you had the leverage availability was down significantly, and then it started building back up until we had this total collapse in the financial markets.
So where do you see the main opportunities right now?
Oh, I couldn't tell you that. Where do we see opportunities? Well, number one, we like technology, and we are investing in technology companies, and we have one situation which will probably be announced in the short term. We like energy. We have made a recent investment in a company that has a major play in the Marcellus Shale field in Pennsylvania and New York State, and we feel very good about that play. We're looking for other energy-related types of investments. We like that. We also would, I would say that there are geographies that we like. For example, Asia. We are looking at a number of things. We made a recent investment in China in Far Eastern leasing. We're looking in India and are quite active there as well. So it depends on geography for us. It depends on certain industries that we like.
Now you're going to be, well, you're already a publicly traded company, but soon you're going to be going onto the New York Stock Exchange, or at least that's the plan, right?
Well, that's a plan, either New York Stock Exchange or NASDAQ, but we'll be listed in the States, we hope, at some point next year once we make the appropriate filing.
Why be public? How does it help you seize these opportunities?
The reason that we want, we think having capital and having permanent capital is really important, and that's what this did. This was a very interesting backdoor merger where KKR merged into one of our companies called KTE that was basically at market at net asset value about $3 billion of our own investments. So what it did was it now makes us by far the largest investor in our own companies, much larger than any of our limited partners. We'll have, at the time the deal was done, about $4.5 billion that we will have personally, because KKR was a partnership, invested in our own transactions, number one, own companies. So besides the fact we'll have permanent capital, secondly, we now have an ability to attract and retain people even better than we did before. A lot of people say, oh, you only did it so that you can cash out. Well, the interesting thing about it is, number one, we're not selling any stock. Unlike any of the other firms, financial firms that have gone public, we are not selling any stock at all. Our whole reason for doing this is to raise capital, and we need capital in our business. And it gives us the opportunity to also finance ongoing new initiatives that we will take, where we can finance them ourselves for a while before we go out to the market and raise capital on the outside. And those are some new initiatives that we are trying here that gives us that opportunity to do that.
Well, we look forward to following the next chapter.
Thank you.